Financial markets are in crisis this morning after a collapse in share prices around the world. After a fall of more than 3% yesterday, the FTSE 100 is down by just over 2%. Germany's DAX is down by a similar amount, reflecting wider fears the Eurozone could be heading into another crisis, with possibly Italy or even Spain ultimately defaulting. Well, in Paris this morning, the CAC's down a little under 1.5% as well. Let's take you through those figures in Europe following dramatic falls across the globe. Well, Japan's main Nikkei index closing down 3.72% at 9,299 today. Biggest fall that since the earthquake and tsunami back in March. Hong Kong's Hang Seng closed just over 4% down. Whilst in New York last night, the Dow Jones, it closed down over 500 points, 4.3%. Biggest one-day fall since the height of the financial crisis in 2008. Well, the former Lib Dem Treasury spokesman, Lord Oakeshott, says there is an element of panic in the markets at the moment.
I think we should keep a sense of proportion. I've been in the city for 35 years now, and it's August. Often you get much more reaction than you should because all the top people are away on the beach and the junior people who are here tend to overreact. There is a problem. I think the big part of the problem was that the Eurozone didn't deal with Greece firmly and properly when they should have done. Greece should have defaulted, should probably have come out of the Euro. And because they didn't deal with it, then the pressure starts building up on the other countries which are not in such a bad position.
Well, there are fears that Italy could be the next Eurozone country in need of a bailout, sparked by yesterday's collapse. But the Treasury Minister, Justine Greening, says the UK is taking the right action to try to minimise the effects of financial turmoil in Europe.
Clearly, the Eurozone leaders now need to continue working to take steps to bring stability to the Eurozone. That's not just in their interests, it's in our interests as a country too. But I think what it also shows when you look at the UK is actually having that plan in place, that very clear-cut plan about getting public finances back into order, about making sure we're getting the economy back on track. And there is growth in our economy. We are creating jobs. That in itself can be a very strong way to build confidence in your economy as a whole.
Well, market experts say it's not just the Eurozone debt crisis which is fueling the market's fears.
Sovereign debt is absolutely huge, and countries that weren't on the or aren't on the periphery, such as Italy and Spain, are being dragged into the crisis. And it's not only sovereign debt; it's also issues with regards to the US as well. We know growth is anemic there. We know quantitative easing, all this financial stimulus that was propping up UK or global equity markets over the last couple of years or so, has come to an end.
Let's talk some more about this story then in the company of Sky's city editor Mark Kleiman, who's in central London. Our Europe correspondent Robert Nisbet's in Rome. We'll talk to him a little later on. Ashish Joshi is at the IG Index trading floor in the city. And Peter Spencer, our political correspondent, is in Westminster as well. Gentlemen, a very good morning to all of you. Ashish, if we can begin with you. These are fluctuating markets, aren't they? It's pretty volatile. Some heavy losses to begin with, bouncing back slightly. What's the picture now?
Well, that's exactly the scenario for right now and will remain throughout the day. Colin, that was the word I heard used bandied about this morning. There were a few gasps and sharp intakes of breath. We were tracking the FTSE's fortunes before it opened, and then we just saw it go down from 90 to 100, 120, and then fall to 160 points. And then there was that rally you were talking about. We still don't understand exactly how it's going to play out, but there has been a sustained rally for a little bit. But there is still genuine uncertainty and fears about what's going on in Europe. If those leaders were having this meeting, the leaders of France, Germany and Spain, if they can say anything which will calm these frayed nerves, well, that will be good news as well. And 1:30 this afternoon, and we'll be looking across to the Atlantic to have a look at the unemployment figures. Manoj Ladwa, the city analyst who was just speaking there about what's going on in America, there's real lingering doubt about the American economy. All of this is playing on people. It's creating uncertainty, creating doubt. They don't want to take this risk anymore. They don't want to be exposed to more risk. And in terms of August, the questions you were posing earlier, yes, it's true that sometimes during the summer anything that happens in the markets can look like it's being exaggerated or is a little exaggerated. But then I was told by a Citi analyst a little while ago, remember Northern Rock, that happened in the summer too, and people saying at the time, oh, it's the summer, we'll get back, you know, as soon as the new season kicks in. But that wasn't the case. So people are being a little reluctant right now to be so dismissive, and they are genuinely worried about what's going on around the world.
Not far from where Ashish is standing on that trading floor, our city editor Mark Kleiman is gauging the mood across the city as well. And Mark, with particular reference to those half-yearly figures from RBS, they were pretty poor, those figures, partly because RBS, in common with other Northern European banks, is exposed to some risk of contagion, some Greek debt. And that's a real reminder, isn't it, when we think back to 2008, that knock-on domino effect, which might yet happen.
That's right, Colin. There's quite an interesting point about RBS's write-down of £840 million in relation to the value of its holding of Greek government debt. The finance director of RBS spoke to journalists after the results statement was published, and he made a pretty thinly veiled criticism of the approach taken by banks elsewhere in Europe, the French and German banks particularly, in relation to how they have treated their exposure to Greek government debt. RBS has taken a more cautious approach to writing that down. And why this is interesting is because it highlights the uncertainty among investors at the moment about who exactly is exposed to what. There is a big debate going on between the big UK banks and the city regulator about how exactly they should be treating and disclosing their holdings of the government debt of these troubled Eurozone economies. And that feeds into the general uncertainty in the market about just how bad this is going to be. I should point out, of course, RBS, the other UK banks, they're much healthier than they were in 2008 when RBS and Lloyds had to be rescued by the British taxpayer. But we are in that kind of feeding frenzy at the moment where investors are just uncertain about the extent of the exposure of these banks to these very troubled European economies.
And Peter Spencer, as Mark Kleiman was making clear there, the government would point to the fact that RBS and other British banks are in a better state than they were a couple of years ago. They'll also make the point that there are figures at the helm right now. Yes, certain figures are on holiday, but people like Vince Cable, the business secretary, are still around to deal with any crisis. And, you know, ultimately this is a global crisis, and the role that any national government figures, certainly here in Britain, can play is necessarily limited.
Indeed so, and especially in Britain's case, because we are not members of the Eurozone and it's largely a Eurozone problem, or hopefully it is at least at this stage. But behind that, if the reverberations spread outwards, then the pressure on David Cameron and George Osborne in particular at some point to think about the fact that Plan A may or may not be working, will grow on him. And so possibly while David Cameron's away, he might switch his focus away from his holiday reading of public schools and donuts and give that a bit of thought too.
Peter, thanks very much indeed. Peter Spencer in Westminster. Well, of course, David Cameron, as Peter was saying, on holiday right now in Tuscany, we believe, in Italy. In the capital, in Rome, the Italian government, thinking very hard about some of their financial problems. Our Europe correspondent, Robin Nisbet, is there. Robin, a very good day to you. They have serious problems, as do, of course, the Spanish, the Portuguese and other countries. There are some in Italy blaming outside factors, short selling by the hedge funds, all the rest of it, but they do have problems.
They do. There's an enormous debt mountain here. It's as simple as that. It's about 124% of gross domestic product here. So imagine if you were earning £100,000 a year and you had a loan of about £124,000. That's pretty much the situation that Italy finds itself in. Although, of course, it's not putting all of its cash into that loan. But the longer it takes to pay back what it owns, international creditors, obviously, the more it costs the country. To give you a snapshot of how Italians feel here, there was a poll conducted last month, with 76% of Italians saying they were very worried about the financial situation. 50% saying very worried, and the remaining 26% saying that they were worried. And that was before this latest crisis in the markets. If we look at what happened a few hundred miles away from where I am now in Milan, at what happened when trading opened today, stocks fell sharply. They have now recovered, but there has been some very disappointing news in terms of GDP growth, showing that Italy's growth is still very sluggish, one of the most sluggish countries in the Eurozone, and that, of course, is not going to boost confidence here. In terms of the political reaction, Silvio Berlusconi is going to be talking to his business development minister later on today. There may well be a press conference, and of course we know there's going to be toing and froing telephone conversations between Germany, France and Spain as well. A lot of concern here in Italy that the markets are betting against Italy, and that Italy has somehow been picked on, and it's a very different case, they argue, from somewhere like Spain, where there isn't a huge amount of private debt being held. There aren't a huge amount of international creditors that are exposed to Italian debt. A lot of it is held here. So they say they're a very different case. Look at their budget deficit, only 4% annually, they say, compared to 10, 11% in places like Spain. So they say they're a different case. It's unfair that they're being picked on by the markets.
Robert, what should we make of these reports suggesting that there are divisions at the very top within the Italian government, that Berlusconi and perhaps senior Treasury figures don't necessarily see eye to eye?
Well, this is very true. Silvio Berlusconi handed over a lot of responsibility to his finance minister Tremonti, who became, in effect, the lightning rod for a lot of the criticism about how Italy was dealing with this historic debt that it had mounted. Of course, a lot of this debt is historic. It didn't come from the credit crunch. It dates back from the 80s. But there has been a persistent criticism that Italy hasn't really got to grips with paying off its debt quickly enough. But you had initially a united front between Berlusconi and Tremonti, but recently there has been talk of a split between the two men. Tremonti now involved in an ethics scandal, certainly at the peripheries of an ethics scandal himself. That is causing some concern that maybe the government hasn't necessarily got to grips with it. And Colin, of course, remember, this is August. Most people who've travelled to old Europe during August know that much of Europe kind of shuts down, and I think this is part of the concern that some people fear that governments in old Europe aren't maybe necessarily taking this too seriously, and you see leaders on holiday when they should be at their desk battling this. Berlusconi today making it clear that he is getting to grips with it, that he is talking to his business development minister, and we may hear from him at a press conference later on today.
Robert, thanks very much indeed. Robert Nisbet there, our Europe correspondent in Rome. Just hearing from the Downing Street Prime Minister's spokesman, this with regard to calls in some newspapers and elsewhere today that perhaps the PM, Chancellor, Deputy Prime Minister ought to consider truncating their summer holidays with a view to dealing with the crisis by coming back to the UK, the financial crisis, that is. This is the line from the PM spokesman. Constantly monitoring the situation is number 10. We are in close touch with our European counterparts. The Chancellor and the Prime Minister are being continually updated. So that's the line, that's the message coming out of Downing Street right now, that they are being kept in touch with what's happening internationally. Let's take you live to Canary Wharf. Richard Cookson, Global Chief Investment Officer at City Private Bank. Richard, a very good morning to you.
Good morning.
We're billing this as perhaps a rerun of the global financial crisis that gripped us all in 2008, if not sooner. What's your view?
Yeah, it's an extension of the global financial crisis. Essentially, the global financial crisis was caused by the private sector taking on too much debt, hence the credit bubble. And what's been happening after that, or since then, is that the private sector has put its hands firmly in its pockets. In other words, it's started to save both corporates and particularly households, and governments have basically borrowed and spent on their behalf. But the trouble is we're running into the binding constraint there, which is why governments are having to rein in their deficits. You were talking about the Prime Minister and George Osborne. Well, of course, Britain really has no choice but to tighten fiscal policy. Otherwise, markets do it for them. So there's really three big problems that feed from that. The first is Europe. And Italy, the basic problem, as your correspondent was saying, was that it just has too much debt. And it's just not growing. I mean, it hasn't grown much for a decade now. The trouble is that the higher their financing costs go, the higher that budget deficit goes, and the faster those debts increase. So that's one big problem. And within Europe, of course, the only real solution to this is for Germany to use its balance sheet to bail out the rest of Europe. Within Germany, there is understandably a lot of opposition to the idea that the Eurozone gets turned into a transfer union. We saw the president of the Bundesbank, Wiedmann, really explicitly against this idea as well. Across the other side of the pond, of course, we've got the US, again, private sector saving, and you've got the fiscal tightening. We have also the end of quantitative easing, which happened at the end of June. So really what you're seeing is economic numbers coming out of the US continuing to disappoint. They've been disappointing since the end of February. The surprise to us is actually it's taken this long for equity markets to take notice of what bond markets have been telling them. Bond yields have been going down and down and down and down everywhere, at least safe bonds, and that really reflects the idea that growth potential is falling, just as it did in Japan in the 1990s.
Yeah.
So
Richard,
that's our big problem here.
Richard, let's just try and separate those two problems if we can and deal with them sequentially. We'll talk about America in just a moment and whether QE ought to be resumed in some capacity.
Yeah.
But just on Italy, there seems to be a concerted effort on the part of some Italian politicians to say it's all the fault of those nasty Anglo-Saxon short-selling hedge fund traders. Is it?
No. Really what's happened is that a lot of, as it were, real money investors rather than sort of speculators and hedge funds, real money investors cut the three little pigs, i.e. Greece, Ireland and Portugal, from their benchmarks and loaded up on Spanish and particularly Italian bonds. As those spreads started to widen, they've been forced to sell. And actually the selling pressure has been rather more than is apparent because there's been lots of redemptions. So this is real investors losing confidence in European politicians' ability to doing anything about this crisis. And I have to say that when it comes to Italy, the Prime Minister Berlusconi is something of a joke. His relationships with Tremonti are even more of a joke, and understandably clients are worried. Ben Bernanke is seen as a very serious figure, far from being a joke. What will his next move be, do you think? Will it be more quantitative easing? Will there be more printing of money? Yeah, ultimately that's exactly what's going to happen because the Fed will have no choice. If you've got a situation where you're tightening fiscal policy, you've got, unless the economy slows because the private sector is saving, you've got to start easing the quantity of money rather than the price. The price is nothing anyway, so you can't do very much there. The question is one of timing. And the problem there is that, Congress came out with a very lightweight fiscal tightening package, so the Fed will feel to some extent as though it's monetizing that debt. B, inflation expectations are a lot higher than they were last summer, and C, so's the stock market. So it's unclear to me that they will be acting in the short term, but ultimately, given they've got a dual mandate to maximise employment consistent with price stability, they will have to do something. I would bet that it's more likely to be in the autumn of this year rather than now.
OK, that's Richard Cookson, the Global Chief Investment Officer at Citi Private Bank. Richard, thanks very much indeed.
Pleasure.
Well, in part, the volatility this morning has been sparked by concerns that the US is on the brink of falling back into recession, part of the reason why the Dow fell as much as it did yesterday. Sky's Hannah Thomas-Peter is in New York.
The headlines are already saying Wall Street plunges in worst sell-off in 2 years. Investors were saying there was nowhere to hide. A very high percentage of stocks fell in value. In part, that was really to do with the fear and anxiety about the debt crisis in Europe and fears that European leaders have run out of tools to deal with that crisis. But there is plenty to worry about at home for American investors. There is talk of the possibility of America slipping into a second recession, and that is off the back of some really alarming numbers, very high unemployment rates which just won't budge, very poor manufacturing figures and a very low, slow growth rate. Investors are looking for unemployment figures out later today with some trepidation.
Hannah Thomas-Peter in New York. Now, the energy company E.ON has announced it is increasing prices in common with other energy companies right now. Gas from E.ON will go up by 18.1%, electricity by 11.4% from September. British Gas, Scottish Power and Scottish and Southern Energy have already announced similar increases. A care firm offering support to hundreds of